before we get going, we'll do quick introductions, then we're going to take a little survey of the room, and then we'll kind of go from there. So my name is Joe Mannon. I'm a shareholder at Better Price. I co-chair our investment services group. We have offices across the country. Back in my former life, I was an SEC enforcement attorney out of Chicago. I also live about a mile from Ian, so I think we are the two closest panelists in terms of distance where they live, and then happen to be on the same panel, so kind of amusing. I've spoken at a lot of IAA events and other conferences across the country, and I'll let my other co-panelists introduce themselves.
Okay, hi, I'm Melanie West. I'm representing the small and medium-sized firms. I've been at several over the course of my career. I've also worked in private practice, started out mostly representing bank mutual funds, moved more into the wealth management world in recent years, have spoken on a number of panels, mostly for the NRS, and happy to be here, other than the spotlight right in my eye.
Ian McFerrin, I'm head of legal of the Americas for Aviva, America's investors. It's part of a large institutional investment manager that's based in the UK. They have anywhere around 500 billion in assets under management. And I'm part of the overall global leadership team in the legal group. So we see a lot of different trading issues and other issues that come by global asset manager.
Great, and just to kind of give you a flavor, I think all of us have different experiences in trading in a variety of different ways, but what we're curious before we get started is what's the room like? Because what we want to talk about, we want to kind of shift it to kind of who's in the room. So let's start with, raise your hand if you're a wealth management firm. Yeah, that's what I thought, so mostly wealth management. Institutional equity managers, okay, decent number. Fixed income? Institutional fixed, okay, it's a handful, okay, good. Anybody institutional fixed income mutual funds? Like just a few, okay, so you're gonna get short shrift a little bit.
We feel sorry for you.
Okay. Any hedge fund managers at all? And nobody won. Okay, got it. And then I'm not asking for private equity because you shouldn't be in this room. Anyways, but it's all good. Okay, so let's start with just going through some high level stuff and we'll kind of talk about what we're going to go through today. We don't have a lot of time, so we're going to go very quickly. I would say the interesting thing on trading now is the way in which the SEC approaches it. It's very different than it was even 5 or 10 years ago. Much more big focus on data. So one of the things, and I've been involved in many SEC enforcement cases. I've settled 2 SEC trading cases last year, and I've got a very large one going on right now, which I'm involved in. And it's really interesting how data has now played a big part of those cases. There's a group called DERA within the SEC, and they do, I think, a pretty good job of bringing the SEC from when I was there. I don't think we had anybody that knew anything about kind of analytics to a pretty sophisticated world where they're actually bringing experts in on cases. So when you think about your trade blotters, when you guys think about your any sort of kind of best X analysis you're going to do, just know that the staff wants to take your data and run it through its systems, right? So that's a very different world than we were in before. So I think that's something that's important to understand. And the SEC kind of highlights that in their 2021 risk alert, where they basically note that portfolio management practices are a focus of the staff. So very interesting stuff there. We're going to talk a little bit about Best X, but I think the one thing that's always interesting on Best X is it's super amorphous, right, and subjective. So the way I always like to tell my clients is if you're doing it, you're probably okay as long as you're following your procedures, right? Because it's very hard to challenge it. So from that perspective, I don't know if Ian or Melanie, you want to talk a little bit about Best X at your firm and what you do, but what I would start with is there's a really good OC risk alert from 2018. If you're worried about Best X and you don't know what to do in your firm and you always have questions, that's a really great guideline. You can just kind of check the box. Am I doing all these things? Because if you're doing everything in that risk alert, you're probably in really good shape.
Yeah, and what constitutes, some of the things that are on this list is different from firm to firm to firm. So smaller firms, you don't have a large resources. You're not hiring outside vendors to perform, VWAP analyses. It's a matter of doing something. So looking at it, we have a trade oversight committee. It's made up of ops, compliance, portfolio managers, traders, one from each group, basically. We meet monthly. We go over, we look at every trade that we've done. And again, we're low volume, so it doesn't have to be a high automated process, automated report that looks at something, you can literally look at it because it's not big enough volumes to make you go, oh, I don't know what I'm looking at. Something that shows that you're looking at it. We're looking at all of the equity trades. We're looking at discretionary. We're looking at non-discretionary. We're looking at what the commissions were on those trades. We're looking at the directed brokers that are paying too much and talking about, is that right for our clients? Should we be talking to them about why they're still custodied at Merrill Lynch or whoever, and paying way more than their zero commission competitors down the road?
And I think that's so key, is that what Melanie just mentioned, is that for smaller, or for just wealth managers in general, you can't ignore Best X, right? You have to do something. So make sure you've got some procedure or some process, and then make sure you're following it. Because where I think people get in trouble is they don't follow the process that they've outlaid. That's rarely where I see kind of people getting caught up. Now, I think what's fascinating in the world we're in today, particularly for wealth managers, because we're going to stay on that for a second, is zero commissions. Melanie, can you talk a little about how that's kind of impacted and changed the business?
Yeah, so like I said, we're seeing so much of the zero commission traders. So most of our clients are with those brokers, with those custodians that allow us to trade for zero commissions. There are some that are not, so they are completely discretionary. We look out there, we're obviously looking to get the best commissions that we can get, but it's not all about commissions. There are other things to take into account. We want to make sure that we're looking at all facets of the arrangement. Is it the right one for this particular client? In the old days, even when it went to sort of hybrid zero commissions, there were certain types of securities that weren't. So we have, sort of a modified version of our equity strategy or even our balance strategy that includes trading ETFs only. And if you're trading ETFs only, sometimes it's a different cost. It's not zero commissions, or at least it was. Now it's the same. But the point being that you have to make sure that you have to be looking at what your clients are paying for their commissions. That's part of your fiduciary duty. It's part of thinking about Best X.
And Best X, I think, is so amorphous from a concept, right? But when you think about it from wealth management, if it's zero commissions and I now want to start trading with somebody where it's going to cost something, I think you're going to have to ask yourself and document why you think that's appropriate, right?
Right.
And you have to think about it this way. Zero commission doesn't eliminate your obligation to get Best X, right? You still have, what's the price? Are you getting a good price? What's your market impact? What's your timing? All those things still have to be looked at and understood and evaluated and be part of your overall process.
I think
on a routine basis. It just can't be once a year. It's got to be done more frequently than that.
And I think where things have really shifted for the wealth management clients on Best X is less of a focus on equity execution and how that's going, more of a focus on what types of products are you selecting, what are the costs of those products, and is it the lowest cost that you can get? So there's been a number of cases on that, and Melanie, I'd love to hear about how you guys do that internally. How do you monitor for kind of share class selection for mutual funds or other products that you guys might invest in?
Right, sure. Anybody who's paying attention has noticed that the SEC, had so many enforcement cases over the last year. Seems like every time you open up and you get an email from the SEC that tells you what the recent enforcement cases, they're still doing these 12B1 fee cases where, picking the wrong share class where there's a conflict of interest. We don't have any affiliates. We don't have any broker-dealers. So the easy thing for me to do was to just go, oh, don't care, not applicable to me, don't have to worry about it. But it actually made me think. So we're not a big user of mutual funds, but we do use them. And more often than not, we use them because a client came to us and they were legacy holdings. So the client came to us from somewhere else and they had these holdings, particularly if you're talking about a rollover IRA where they came from a retirement plan. And retirement plans are sort of notorious for having really high fee share classes. These R shares are, sometimes 100 basis points in 12B1 fees. And while they're not going to us, they still are being paid by our clients. So what we ended up doing was doing an inventory of all of our clients to see what their holdings were in mutual fund shares, and having, again, putting on my, one of my old hats from when long ago when I worked at a mutual fund company, I remember getting calls from investment advisors saying, hey, we've crossed the $1 million threshold. We're now eligible for institutional shares. Can I convert my A shares into institutional shares? And the answer was always, yeah, sure. Tax-free exchange. Most of the time, all it takes is a phone call. But you have to know you have them. And the question is whether, in our case, we don't typically buy more of those for the clients that we have, but is it our fiduciary duty and is it considered best X if we're just sitting around and letting them sit there? Should we be being proactive and trying to go out to the mutual fund companies and saying, hey, we've got a client, they've got this holding, can we switch them to the institutional share class?
Yeah, where we've seen it the most is I do a lot of advisor M&A where wealth managers are buying each other, right? And you have either you brought a new team on or you bought another advisor and you have all these legacy products, right? So what's happened, at least we've seen, is the SEC staff, when they come in, they will actually say, okay, give me all the mutual funds your clients are invested in. And then they basically look and see, are there any funds that they're not getting the lowest fee share class? And I've had situations where I've had clients rebate fees if it wasn't the lowest fee share class to try to avoid enforcement actions. So really important to kind of make sure when you look across your product line that anything where it's legacy or usually it's come from somewhere else and it somehow didn't get converted to the lowest fee share class, you might want to think about having a process to kind of scrape for that, maybe some sort of periodic basis where you can look out for it. Something that's come up quite a bit in SEC exams, and the staff is very focused on it, so something to think about for sure. Now we're going to talk just a little bit about wrap programs and the concepts of best X in terms of like thinking about it from a zero commission environment. I think what's really interesting is in this new world we're in where Schwab and TD and Fidelity don't charge you anything, what about then allocating to third-party asset managers? Does that somehow, where there's commissions being paid typically to those managers and the clients are getting charged, how does that look? Does that look like something I can still substantiate? And I think obviously the answer is yes, but I think you're going to need to think about the commission aspect of it in a different way. So I just think that the zero commission world, while it made Best X really simple for your day-to-day, it kind of created this little tangents that you have to think about from a day-to-day perspective. So from that perspective, I think it's just a good idea to think about it. Other things I'll note, this is just random. I've seen a rise of like my wealth management clients creating their own wrap programs because now basically commissions are free. They're actually starting their own mini betterments and mini type of internet-based solutions. So that's a trend. I don't know if it'll continue or not, but it's been interesting to see even very I'd call it sub-billion-dollar managers looking at ways to kind of offer internet-based products, which has been interesting. Since we haven't let Ian talk at all, we're going to talk a little bit about Best X for institutional managers, for those of you in the room that are institutional.
So for us, the question first came up whether or not we're a fundamental or quantitative shop. We have both, sometimes within the same strategy. So we tend to look at best execution more from a quantitative data analysis than anything else. And then from our standpoint here in the U.S., being connected to a large insurance company, we do a lot of credit, right? And credit has historically been difficult to figure out what best execution is, what's it look like, how do you tell? But over the last 5 to 10 years, the advances in technology and information around trading has advanced tremendously with the implementation of Trace, your OMS systems being tied to that data along with the third-party trading platforms. All of that information now is being used real time to help you determine what best execution could look like. And so you can start scraping a lot of that data. Your traders can start looking at it on a day-to-day basis to figure out how they're coming up with best execution. So like trading platforms like TradeWeb, LiquidNet, ICE, and Bloomberg are all things that we use every day to figure out, all right, where do we place our trade? Who has the best price? We do portfolio trades where we give the whole portfolio through TradeWeb to figure out how we can do it. So then how do you look at best execution? Do you look at best execution as a whole portfolio trade or individualized within that portfolio trade? We tend to give a little room on those ones that may be off a little because the benefit was so much higher on some larger position. So we do look at that both like from a big granular state into a grand state. So that's how we look at it from that perspective.
On the wealth side, we do something similar. I mean, you can still look at all of the data that's available in the technology world, the Trace and such. We've used that for multiple purposes. One, you can use it for, when you're comparing your pricing services. Are they doing a good job? One of the things, obviously, the fewer pricing services you have, the more you have to be comfortable that they're doing a good job. We want to make sure that the ones that we're using are good, so you can compare it to what you're seeing in Trace. You can also use it for Best X. we look at our pricing for what we got for the price. When we see a trade in a fixed income, we can look at it compared to the most recent price that we got from wherever, from whatever our pricing service is. And on a daily basis, in our monthly review, we also look at the manual version, which is we make sure that we have multiple bids and asks on any given trade in the fixed income world.
And so there's often a question that we put up there, does MiFID II kind of change what we do? What's the difference between all sufficient steps and reasonable steps? I don't know. To be quite honest, I don't know the difference. But the robustness in which you do your analysis and what steps you take probably hasn't changed for large global managers or more quantitative managers because they're probably doing a lot. And then managers who are solely domestic, only have domestic clients, they're probably doing just fine as well. But I can talk what we do. And go through kind of how we analyze and look at best execution. Ours is a layered approach. So we have the traditional trading practices committee that reviews the third-party trading analytics provider data. So we do that like Melanie does. You have head of legal, you have chief operating officer, all the chiefs are there going through the data. Then on a monthly basis, our traders and risk team meet to go over all of the executions. I don't attend those. There's a lot of math. There's a lot of arithmetic wizardry going on, a lot of Greek alphabet stuff going on, and I don't attend those. But it's really pointed discussions about best execution, again, on a very granular level. What we also have, which a lot of firms don't have, kind of mid to lower tiers, we have a dedicated team that studies best execution on a daily basis. So they're looking at every execution every day from multiple data points.
Yeah, we have that too.
Versus different, like they use TradeWeb, they use Bloomberg, and they come up with tolerances for each trade, both in terms of the commission charged and the price. They then go and challenge anything that's out of tolerance to that trader that day or the day after. And then that piece is recorded. They ask for the rationale. Usually the rationale is there's a weird market move, like right there, or something that's weird that happens. But every day, and that gets recorded. The traders have to respond within 24 hours to that challenge. And then that data gets collated to figure out if there's any trends in that particular trader's book. Is he getting or she getting best execution? That data then gets fed back up to the monthly committees and then to the quarterly committees. So they have a dedicated team, and they have separate data streams that they can look at and different analytical tools that they're using. So it's probably the more robust one that I've seen in my prior experiences, but it was impressive when I got there, so I figured they were doing all sufficient steps to get best execution for their clients under MiFID.
I think not all of us work at a $500 billion asset manager and have those kind of resources, so that's pretty cool. From my perspective on it, I think it all comes down to two things. Did you have a process, and did you keep the records? On the records piece, I think that's where I see people fall down with the SEC staff. So, for example, we spent a lot of time last year with the SEC on a case where we really were trying to drill down. They were trying to get information about the bid and asks on a bunch of trades, and the client just didn't keep the data in a way in which we could produce it to the staff. And it basically, not having the data really hurt us in our ability to kind of make arguments against them. So when it comes to best X, and when it comes to, frankly, any of the trading issues you come up with, having more records of what you're doing, I think, is critical, and just not relying on, oh yeah, this trader took a Bloomberg message and then saved it down, and nobody knows where the Bloomberg message is. I've been through millions of Bloomberg messages over the years, and it's not always the best way to do things. So I think from that perspective, understanding what your records are and how you maintain them is such a critical component, I think, of trading practices.
Yeah, and understanding what your portfolio managers do. So a lot of times your portfolio managers are taking notes. They've got their own little spreadsheet that they use, and you might not be aware of it, but it's data that you'd like to have. And so you may want to sort of ask, what do they keep track of that isn't being recorded sort of formally anywhere, and maybe you do want to record it formally. We have, again, a column in one of our spreadsheets that's, comments or notes, and that's where that goes, because we did learn that, yeah, there's stuff going on there, and that's the kind of thing that down the road, when nobody remembers why it was, there's the little note that tells you why.
Absolutely. Okay, we'll talk a little bit about soft dollars. I mean, soft dollars have kind of, I feel like it's been played out, so everyone kind of knows where we're at now, post-MiFID. But maybe, Ian, can you just talk a little bit about where you guys are at in terms of it and what your firm does on that front?
Our firm, we're a UK firm, so the UK hates soft dollars, so we don't do soft dollars at all. We haven't done them forever. Also, a lot of our clients on our institutional side prohibit the use of soft dollars. So, you're stuck between your parents saying, no, you can't do it, and clients now saying no. There is a significant number of institutional accounts continuing to say no to soft dollars, and they're using consultants, and consultants are global in nature. So you'll get the same no from an institutional client in Japan, in Australia, in France, and in the US. So they're all going to say no, potentially from the same consultant, like Aon or whoever. The other issue you have to think about with soft dollars, even though it is pretty played out, is what's the population of your no soft dollars versus your yes soft dollars? And it creates a free riding problem, right? And so where's the tipping point where you say no completely to soft dollars, right? Because if you have so you have to look at your percentages and the type of clients you have that say yes. So if the majority of your clients say yes, are ERISA accounts, you really need to take a good hard look at why you're allowing ERISA assets to benefit other clients. That potentially could be a prohibited transaction. So you want to make sure you're looking at that in some detail. Same thing if you have sponsored mutual funds. The trustees, if they're doing their job, are going to ask you point blank, why are we paying for this, for all the research, and half the assets are somewhere else? So you're looking at your percentage of assets for each one. And I think the SEC will start to pick up on that, if they haven't already.
Yeah, the other thing I would just say on the institutional side is that it seems like it's gone pretty far to we just ban soft dollars. We do have a handful of clients that still have the bifurcated approach, or they just do it flat out. It just depends on your product mix. I mean, I think it comes down to where do you sell your products and who are your clients. If you have a very U.S. focus, I think people still do it and get away with it. If you're more international, I think it's very difficult to kind of still do soft dollars in that world today. If you're a wealth manager, I think you'd have to ask yourself, what are you doing? So I think it's always a good one to kind of think about it from that perspective as well. But that being said, even though, a lot of times wealth management firms don't use soft dollars in the traditional sense, they still get research benefits. So Melanie, can you talk a little bit about what you see there in terms of your firm and how they approach it?
Sure. I mean, so we have always taken the position, from way back that, we don't have formal soft dollar arrangements, right? So we never, back in the old days, it was, you promise you're going to do a certain amount of volume with us. We don't have enough volume to justify anything anywhere, so it doesn't end up in that category. But that said, we do get things from the brokers with whom we trade. We get some incidental research. We call them incidental services, something along those lines. I think in our ADV, that's how we describe them, as incidental services incidental to the use of the brokerage services. We choose the broker based on the broker and the brokerage and the execution. And as an incident to that, we get some benefits to it. And the way that we look at that, we still disclose it as soft dollars, but the way that we look at it is, because if the broker tomorrow came to us and said, you've got to pay for this service, there are none of the services that we currently use that we would say, oh, okay, we have to pay for it. There's nothing that we get that is something that we genuinely want and have asked for, and so it doesn't go into the factor of choosing that broker, which helps us in terms of, again, thinking about best execution. We can be comfortable knowing that the reason we're trading with broker X has really nothing to do with what we get from that broker. In terms of disclosures, like I said, we talk about it as saying we have no formal soft dollar arrangements, but we do receive incidental benefits from trading with them. I think this CAN disclosure from platforms note on the slide is intended to say, but there are other things that we get from certain things. So for wealth managers particularly, a lot of us are on these Schwab platforms, the Fidelity platform, the TD Ameritrade platform, and you get more than just the typical sort of research or the things that we all think about when we think about soft dollars. But this is a conflict of interest type disclosure. So are you talking about the fact that as a, whatever they call it, preferred platform, institutional platform user, you have access to a host of, regulatory, resources and conferences and consulting type services and all those kinds of things that the Schwabs of the world offer to you. And if you don't have them, you should. Most of them give you nice canned disclosure, but not everybody uses that. We don't. We have something that's very similar because we have multiple that we work with, so we want it to be sort of one size fits all. But
There's no right answer to that. It's just go through it. And if you're going to use the canned stuff, which is totally fine, just make sure that you've actually read it and it makes sense and you don't just drop it in. I think that's the one thing always that's important to do. We're going to talk a little bit next about trade allocation. I think this is an area where the staff, the SEC staff, has kind of upped their game, for lack of a better word. They really, I think, through the DERA, through their kind of quantitative analysis that they're doing now, I think you can expect a much different exam than you would have 10 years ago when it comes to trade allocation. So, in fact, I'd love to hear from you guys on your recent exam experiences on trade allocation and kind of what you see the staff do now when they come in the door.
Well,
Go
go
ahead.
ahead. Well, we just had an exam. Fortunately, for us, again, we have very, fairly low volume trading. So it was not a huge issue, but just like Joe suggested, they did very much want to see our trade blotters in a specific format so that they could run it through their number crunching algorithms and see if they spotted any trends. And truthfully, nothing came up from us on that gave them the kinds of issues that they were concerned about.
Yeah, ours came up 2018, 2019, same experience, running all the data through DERA. Luckily, we didn't have anything come up. We do pro rata, and we have a process for looking at our trade allocations on a daily basis. We have an exclusion report that comes out every day that talks about any account that could have been within a bundled trade but wasn't. So we analyze what happened there, and we also probably, as all of you do, performance dispersion against a composite to figure out, all right, what's the reason for that dispersion, and can we explain it? So that's kind of how we're looking at trade allocations.
Yeah, so when you think about this concept of trade allocations, like what are we even talking about? So this is a tough one because there's no rule, there's no guidance, it's just pure principles-based regulation, right? So from that perspective, it's just your general oversight fiduciary rule of 206 of the Advisors Act. That's what's kind of kicking in here and setting the stage. So the term you hear a lot is fair and equitable, and what does that even mean, right? What does that concept mean? Because the SEC staff could decide that, well, what you're doing is not fair and equitable, but what somebody else is, may be. There's a couple of basically no action letters that govern a lot of this. The two that are up there, SMC and Pretzel Stouffer, are really old, but they're just the good guidance to remember that, basically pro rata allocations are going to work. And if you're doing pro rata allocations in trading, you're probably going to be fine as a general rule of thumb. But that doesn't always work, and we're going to talk through some specific examples and different scenarios here of what else are people doing and how does this stuff kind of work. So from that perspective, I'd say what I get ready for when you're getting for your exam is be sure you can produce your trade blotter in a great format and do it kind of quickly and easily. And then just making sure that when you do allocations, you have a process around that allocation. So if you've got your procedures in place, that those are being followed. That's where I see people, again, fall down, is they've got to practice, but then they don't follow it. That's always where people get in trouble. I always tell my clients, I'd rather you not even have a procedure if you're not going to follow it. Right? So just always do what you say you're going to do. All right, so there's various ways that people do trade allocation methodologies. There's pro rata, which is obviously the most common. There's rotation, which we'll talk about in a second. There's randomizing, which we actually talked about a little bit earlier. Not something you see too often, but it happens. And then there's limited opportunities, so we'll talk about that. That comes up a lot of times in wealth managers where you've got privates or other things that are limited availability for clients. In terms of where I think people need to focus in this particular area is what disclosures are you putting out in your Part 2? So what do you say? So for example, if you say in your Part 2 that everything's pro rata, but it's not pro rata, that's a problem, right? If you say that everyone gets opportunities, but they don't, that's a problem, right? So I usually draft trade allocation language very specifically to be very flexible. So usually I'm not super tight in the part two, I'm going to give myself flexibility to go either way. So for example, let's say that my practice is fair and equitable, but maybe we have limited opportunities, we won't do that. We won't do a pro rata, or we won't always give opportunities to everybody. The way I always like to put it from the SEC's perspective, and this is probably not the best way to say it, but this is the way I've always thought about it, is the Advisors Act basically says that you have to give full and fair disclosure of the facts. So if you're going to screw somebody over, you better tell them you're going to screw them over before you screw them over, okay? So as long as you tell them you're going to get screwed over, you should be okay, right? That's the way to kind of think about it. So from my perspective, that's kind of the way I've always approached it and the way we draft a lot of the client disclosure. So from that perspective, let's talk a little bit about your own practices at your firms and how you guys go about trade allocation. Go ahead.
Well, I mean, so I think we all mostly start with pro rata. So that's the default. But obviously, that doesn't always work because sometimes, particularly in the fixed income world, we've found that when you have lot sizes that you have to deal with, if you don't get the full allocation, like in a muni deal or even a new issuance of a corporate bond, you may not get everything that you want. And so you have to figure out what to do. And the easy is, okay, pro rata, and then you realize, okay, well, now we've got lot sizes that are too small, so you take the bottoms that couldn't get them and you push them up to the top, except that doesn't work because all the ones at the bottom now are the ones that are always excluded. So that's where this sort of rotation comes in. Particularly if you have a group of accounts that are typically going to be purchasing in the same type of purchase. So if it's always going to be a muni group or it's always going to be a particular type of corporate bond that it's in the same group, you can put a rotation in that group. If it's not, if it's just across all of your accounts, it becomes a little more challenging to keep track of, but that's all it is. It's a matter of keeping track and making sure there is a rotation. And that's the kind of thing that you do, from my standpoint, is to look and see when there was a revised allocation from the original, when you didn't get your full allotment, how was it handled? And looking at those and seeing where the same accounts kept dropping off every single time, that doesn't work. Random is in that same category. So again, we did have at one point, a group of 10 or 12 of basically the same account. They were related accounts. They were of differing sizes, and they basically were managed in almost exactly the same style. So every time there was a buy or a purchase or a sale, it was essentially the same bond. And so when there was a buy, if we wanted to buy and we were lost, that's where we randomized because they were all about the same size, and so it was going to be the same thing. So we just sort of said, okay, whatever's going. And that's what we do.
And I think your comments are well placed because there's not a right answer when you're trying to figure out your trade allocations. You can do it in a variety of different ways. Even in kind of one trade group, you can do it. You can do rotation, you can do random, you can do pro rata, all in the kind of the same trade depending on the type of clients you're dealing with. There's not a right way to do it. The most important thing, as Joe said, is to make sure you're following what your disclosures are and what your procedures are, and then you test it over time to make sure you're doing what you say you're doing, because if you don't test it, you can't prove out that you're doing, giving the fair and equitable over time treatment to all of your clients. We do pro rata. We generally don't have issues for conflicts because our clients are of a certain size that we really never run into the odd lot issue for smaller clients. So that doesn't happen to us. So ours is pretty straightforward from that perspective, at least here in the U.S. And I try not to go into real assets and other stuff and infrastructure debt over in the U.K., where it's probably more problematic in dealing with trade allocations. But for us, it's pretty straightforward. And what I was saying before, we do daily exclusion reports to try to figure out why somebody's excluded. All of that stuff is documented, and then we do dispersions.
Let me throw out another thought that the odd lot discussion, it's an odd thing that came up with us. We took over some portfolio management from another advisor, and one of the things we noted that we went to try to sell a piece in one of the portfolios, and turned out that it was a lot that was below the minimum lot size. And the reason that it was below the minimum lot size is because they had previously had purchased, again, kind of thing, didn't get their full allocation, and they pro rata pushed it down to all of the underlying accounts. So several of the underlying accounts had below minimum lot size, which made for selling those pieces. So just if you run into this, if you're small like we are, and you have the potential to end up with a smaller than minimum lot size, make sure you know what the minimum lot size is before you're settling and allocating trades.
And then just one more thing that obviously the SEC will look at when they're looking at your trade allocations is the accounts that you have performance fees on. This is obvious, right? So they do that, and then if you have mutual funds, are you favoring your mutual funds or large accounts that you get more account revenue from than other accounts?
And
So they're going to be
proprietary
really looking at those things.
Yeah, proprietary accounts, and particularly for smaller advisors, if you have proprietary or seed accounts or if accounts owned by the asset management firm, if those are getting allocation differentials, they'll definitely focus in on those as well.
Especially if it's seed capital that you're coming out with a new fund, you really want to pay attention to that seed capital accounts where you're trying to grow your track record, and all of a sudden it's getting a bunch of allocations that you're like, hey, you're a really small account. Why are you getting this favorable treatment?
Yeah, one thing that came up a couple years ago is people were buying, there's actually a case against PIMCO, I think, with ETFs where they were buying odd lots to try to juice performance on the funds. And I think that you just got to remember that anytime you're seeing sort of unusual activity somewhere, try to pick it up. Odd lots is always one where if you hear that term, something you should always be kind of focused in on if you're trading fixed income. Talk for just a second on models. I think the world has definitely moved to model delivery. Most of our institutional managers do model delivery in some way, shape, or form, which makes trade allocations complex because you have non-discretionary models, you have discretionary models, you've got all sorts of different kind of variations on it, and people get very exercised, the platforms do, about when am I getting my models and in what order am I getting them, right? So that's, I think, one thing that comes up from time to time. So Ian, can you talk a little bit about that at your firm?
Sure. So I tend to think of models, it's before the trade. So it's the recommendation piece. And when are you giving that recommendation to your trade desk versus giving it to the model sponsor, right? So you really have to think about how this all fits together with the sponsor. You need to ask specific questions, at least in my mind, of where does our model fit in, and how big is your model platform? Is how compared to us? Because if it's huge, you're going to have a much bigger impact on trading in that name than we are, and vice versa. How does this all fit together? As Joe said, are you discretionary or non-discretionary? Do you have to take my recommendation, or don't you have to take my recommendation? Am I one of several model providers in your strategy? So you don't necessarily have to take mine, but you have another asset manager who's in that same asset class. So how does that look? How do they implement your recommendation? Do they do it right away? Do they wait till the end of the day? How are they trading? And then what's the market impact of them being in the market at the same time you are, if they're trading at the same time you are? Might not be anything. So if it's a mega cap name and you're in there and you have a $100 million trade and they have a $100 million trade, it's probably not going to have an impact at all, right? But if it's in a smaller cap name, that will have a dramatic impact depending on the size of that model sponsor. So you really need to think all these questions kind of through, because you don't want to disadvantage your clients who you have discretionary trading authority over versus the model that you don't, right? Because oftentimes the contracts are structured where their clients aren't your client, it's the model provider or the model sponsor who's your client. So you need to think about how these kind of things interact together. The ones that I've seen, the model sponsor wants you, it puts it in the contract that you have to give the recommendation the same time you're putting it to the trade desk. So you really have to think about, do you want to do that or not? It's an economic question. It's a legal fiduciary duty question. How do we reconcile all this stuff? Most importantly, as we talk about any trade allocation or anything else, write down what's your rationale for your conclusion that came up to for your procedure. A couple reasons for that. Once you have your procedure down and what you want to do, obviously follow it. But models change, and how their delivery changes, what times they want to change. Personnel within your departments change. So 2 years from now, the person who wrote that procedure may not be there, and you may not know what the heck you're doing with that procedure and why we developed that way. So it's really good to have a memo to file that says, here's the reason why, here's the characteristics of this model sponsor and what they do. and get as much data as you can. Sometimes it's really hard to pull data from them. They don't want to share their trading with you, but get as much information as you can so you can make an informed decision. It shows you've done due diligence to the SEC, and you're doing the best you can given the data you have.
I think that's all good. We're getting short on time, so we're going to keep going and talk a little bit about cross trades and principal trades. This is the part of the session where I'd call it the third rail. So if you, or the monopoly reference is, if you do this wrong, do not collect $200 and go straight to SEC jail, because the SEC loves bringing cases in cross trades and principal trades. And why? Because it's easy for them to bring the case, right? So like code of ethics violations, easy to prove. You blew a cross trade issue or principal trade issue, usually it's pretty simple for them to prove that you screwed it up. So always be careful when you've got standards that are black and white that can be blown. So let's talk about what a cross trade is and where do we see issues with the staff. So cross trades are situations where you've got two clients and they're under your advisor, right? And you want to basically move one position from one client to the other client. You're not charging a commission. The advisor's not charging any commission to do this. They're just moving the position. Now, for most of you, this is, if you're a wealth management client, this probably doesn't come up very much at all. If you're an institutional manager and you trade equities, this probably doesn't come up too much either. But if you're a fixed income manager, this is a very big deal, as the bid-ask spreads on some of these bonds, particularly if you're trading in esoteric stuff or high yield or structured finance, the spreads can be very big, right? And when you've got wide spreads, if you're having to sell and then buy, that could be really expensive, and the clients could have saved a lot of money by crossing. So there can be significant benefits from doing cross trades. Now, just as a rule of thumb, everybody probably knows this, you can cross ERISA, but just don't do it, because it's too complicated, is what I have to tell people.
It's not worth it, right?
It's not worth it. In the 40 Act world, this is where the SEC loves to bring cases. So if you don't check all the boxes on Rule 17A7 for a cross trade, the SEC staff will just lay it up, just sign up for an enforcement case because it's coming your way. So just be ready for that in terms of understanding. If you are a mutual fund shop, understanding compliance with 17A7, very, very important, which is the cross trade rule. Other things to talk about here is, and I think this is really the biggest topic in this area, and if you have questions on it, I didn't say this earlier, but if you have questions throughout, throw them up. I should have said that a long time ago. So the biggest thing that's come up in the cross-trade world is registered investment companies and Rule 2A5. So what's happened is Rule 2A5, which is the new valuation rule, basically provided a new definition for the term readily available market quotations that differs from historical practices. Historically, with cross trades for mutual funds, you could get broker quotes and rely on the broker quotes and then satisfy the requirements under Rule 17A7 to transact at the mid. So that's basically what the requirement is from the rules. You have to transact at the midpoint of the bid and ask prices that you're getting. And typically you would get 3 or 4 or more quotes out in the marketplace, and then for fixed income traders, they would basically then transact a cross trade it that way. What's really weird, and I don't know the history as to why this is that way, you can, and I'm sure Ian will chime in here, you can value your securities and people can purchase and redeem them based upon IDC and evaluated prices, but you can't cross them using IDC prices. It's good enough for a NAV, but it's not good enough for a cross. So if somebody can explain that to me, I would love to understand the rationale. I think I know why, and we'll talk about it in a second, but it is interesting.
Yeah, it doesn't make a lot of sense to me. So if you can use that midpoint broker quotes to come up with your NAV and you can't cross trade on it, and it benefits the shareholder for you to do that cross trade at that price, especially on the fixed income side, it just intuitively and intellectually there's a disconnect there for some reason. We were talking about it. It's an interesting point that you'll raise in a bit, but it just doesn't make any sense. Why would you have different valuation pieces for your NAV versus your cross trade? It just doesn't make sense.
The way to kind of put the state of play on this one right now is if you are a fixed income manager and you are in the mutual fund space and you want to cross, technically you can still do it, although most people have stopped that practice. There is guidance that municipal bonds can be done on evaluated prices. You can cross there. That's still good guidance, at least for now. It hasn't been pulled. The SEC staff is still evaluating this issue. I don't know that they're going to come out with new guidance, though, and that's a little bit terrifying because the effective date of 2A5 is coming up. And if anybody has more recent information, would love to hear it, but I've not heard anything new. So this is kind of in limbo land in terms of whether or not this practice will continue. The ICI did a really cool study on this issue and said that there's probably about 204 billion cross trades that occurred in 2020 with respect to the mutual fund industry and fixed income. So if you can imagine, if you don't do those as crosses and did them out in the marketplace, the amount of money that's costing clients is actually very significant. Because unlike equities, you know, when you're trading in that bid and ask, it can be pretty wide. And if you're not getting that midpoint price on the cross, that's a very different world. So from that perspective, this is a big deal, still a big deal, and we'll kind of see what the staff wants to do. One thing I'll tell you about is there's a number of SEC enforcement cases right now that are stemming from the COVID crisis. They're still ongoing, but basically what was happening was that when the COVID crash hit, the evaluated prices from the pricing services, they don't always match up with the broker quotes. So what can always happen is you can have evaluated prices here that are not matching what's in the marketplace. And the staff's definitely looking at all that. And I think that's part of why this whole issue on 17A7 and not permitting cross trades has been going on. It's a very interesting issue, and one I think that'll be kind of continue to be thought about and talked about for a long time. Okay, I'll talk about principal trades for 2 seconds, but basically a principal trade is a situation where you as an advisor, you're basically transacting directly with your client is the way to kind of think about it. Either through a seed account that you might own, or through maybe it's a private fund that you guys own more than 25% of, or it can be through like the president of the advisory wants to cross trade with a client. That's when that comes up. There are very specific rules underneath the Advisors Act. If you want to do that, you have to get basically advanced consent and then disclosures to be able to do that. Where people get messed up in this area is they do inadvertent cross trades, or inadvertent principal trades, I should say. And this can happen where you have affiliates. So just be careful. If you're ever doing crosses, this should always hopefully come up to compliance, and you should be looking at those. Be careful who's on the other side of those trades. Always important to understand. And it happens more than you think, but if you do blow it, try to fix it as best you can. This is the one area where the staff will bring enforcement cases with regularity if there's an issue.
And DERA will find it like that. So just, I mean, it'll take them 2 seconds to run it through their machines to find it.
Exactly. And it comes up a lot, like, it's interesting, like CLOs can get complicated. So if you have CLOs, the equity can be owned by the manager. So there's different issues that can kind of come up in this world that you wouldn't think of that would be normally principal transactions, but they can come up. So private funds, a lot of times where you've got a lot of internal capital, can cause issues too. So weird esoteric issues can come up in the principal transaction area. One thing I want to talk about before we kind of wrap up with maybe some questions real quick is there's a 2019 OC alert called Fix. If you want to know about cross trades and principal trades and how to protect yourself, it's a great resource. Again, kind of like the Best X one, you can just check the box and go down the list and you'll be in really good shape for your compliance programs. It's a really good alert that they put out. Last, but certainly not least, I want to talk about future trends and where we're going. Any thoughts on the institutional space, Ian, about what we're looking at for the future?
Yeah, everything's starting to get outsourced. Your back office is being outsourced, your middle office is starting to get outsourced, and I think there was, 4 or 5 middle office outsourcing deals last year. The next one's going to be trading. They're already trading. It's already happening in mid-size and even larger ones, especially if you're equity focused or even fixed income focused. The more esoteric the asset class is, the less chance you're going to have to outsource that. But that's probably the next bigger phase of outsourcing your trading function. And then how does that, just because you outsource the trading function, again, doesn't alleviate any of these trade execution, best execution, trade allocation issues. You're still on the hook as the advisor. So what is your procedures, your policies, your oversight of that third-party provider to ensure that you're getting best execution and your trade allocations are done properly? Because now it's outsourced to everybody. So then it fits in with your vendor management system. It becomes a lot more complicated than you might think.
And any thoughts on the future for wealth managers, Melanie?
On the outsource of trading function?
No, just in general.
Oh, well, you have down here the evolution of zero commission structure, and that is a big deal, because what we're seeing happening is as more and more clients end up with discount brokers that are zero commissions, for the few that are left with the full service brokers, and the even fewer that are left with that offer us discretionary management, that makes our volume of trading really, really low. And so it makes it difficult for us to get reasonable commissions from brokers that we don't work with very often. So what will that do to the price of trading when you've got, if you get to the point where 90% of your business is with zero commission and the other 10% you've got to work with, and it's small volumes, what does that do? Not to mention, how many brokers will allow you to have a relationship with them to do your trading, that it's worth it for them to do all the back office setup and all that. So are you down to only one that you can work with? And is that best X if you've only got one? And what happens if that one that day says, okay, yeah, we're done too. Now what? Who can you trade with? That's a real issue for wealth managers, smaller sized managers.
All right, we've got 2 CLE codes that if you need them, write them down, effective and primary. So CLE codes are effective and primary. Last time, effective and primary are the 2 codes. Thank you so much for coming. We're out of time, so if you basically want to ask us any questions, just come up afterwards. We promise we won't bite, and thank you all for attending. Hopefully we didn't bore you too much. Thank you.